Hello guys, today we will talk something about Masayoshi Son and his business empire, and our presentation roughly contains 5 parts: the general introduction, 2 investment examples, the comparison of Warren Fund and Sequoia Capital China Fund, and lastly the prospect of Soft Fund. And I will show you the first part. Masayoshi Son is a Korean Japanese, but he calls himself the descendant of Sun Tzu, a Chinese military scientist, because he's a big fan of the art of war. Right now, Son's the CEO of SoftBank and SoftBank Mobile, chairman of ARM, and he even used to be the richest man in the world, but only 3 days. About his character, Son is confident, bold, and risk-taking. Bill Gates ever said, "You are a risk-taker as much as me." Son likes to violate rules. Upon enrolling at his new high school in the US, Son insisted that he already knew everything in the book. He argued to take the college preparatory exam and finally got the permission. So he took the exam with a dictionary. He passed the exam and quit the school 2 weeks after he enrolled. A legend, right? Someone success because they work hard, someone success because their fathers work hard, but some both. Son earned his first $1 million at the age of 18, and when he came back to Japan, he founded SoftBank. However, during the internet bubble, SoftBank lost 99% market value, and therefore Son lost about $76 billion, but he never gives up. From 1999 to 2017, Son invested 1,300 companies and earned 44% IRR. You can see from the chart, Son is of great wealth, and he was the richest man in Japan in 2017 and 2018. Let's see the timeline of SoftBank. In 1994, it listed in Japan. 2 years later, SoftBank invested in Yahoo and provided more finance in the same year, becoming its primary shareholder. In 2000, SoftBank invested $20 million in Alibaba. It's a very wise decision because when Alibaba listed, the investment increased to $54 billion. In 2006, SoftBank purchased Vodafone Japan, which is the SoftBank Mobile right now. And in 2012, SoftBank bought Sprint. This is a big failure, and Sprint has continuous loss after its acquisition. In 2016, SoftBank announced the form of Warren Fund, the biggest VC project all over the world. Warren Fund is a private fund for making investments in technology. The target amount is $100 billion, which far exceeds $64 billion that all venture capital funds raised globally that year. Most funds are from Middle East, and over 40% of the funds are debt, which means SoftBank needs to pay $2.8 billion at least as the reasons per year, as the interest. What's worse, the Warren Fund doesn't work as well as some expects. WeWork failed to IPO, Zoom has yet to be profitable, Uber has sunk below its offer price for a long time, while naturally the team suffered a lot of blames. Someone thought the managed team shows waiting Wall Street macho belligerence, and someone said the team has strong individualism. Only Son has the decision rights, and he didn't listen to the people who were pushing back. SoftBank has been blamed a lot recently, but it has its unique company culture. They make outsized bets on startups, and it does tap the potential of some signs in a very early time. Besides, they invest big money and make a fast decision. In the investment to Alibaba, Son only took 6 minutes to make up his decision. But SoftBank intends to get its way by hook or crook. Son always rated Yahoo. If they didn't receive his money, he would invest their biggest competitor. Besides, SoftBank takes high risk. Its debt to market capital ratio is about 1.5. So, SoftBank lends lots of cheap yen to buy US dollar assets. Once US stock market drops a lot, SoftBank may face insolvency.
Hi, this is Wang Haoyi. Up to this point, you may have some rough ideas of what SoftBank is like. Now, here's something really exciting. We are going to talk about the most successful investment SoftBank has ever done, which is the one that made SoftBank's reputation. So that's the investment in China's e-commerce giant, Alibaba. Well, the investment took place back in 2000 when Alibaba was still a very young startup. The investment was so successful that the $20 million invested turned out to be $60 billion around 18 or 19 years later. So we are very eager to find out how did this happen and what are the incentives behind the investments. If we look at SoftBank back in 2000, we can find that it mainly focused on investing in internet-related companies, especially the e-commerce segment. We can see the e-commerce segment accounted for 65% of the group's consolidated revenues for the fiscal year 2001, and a big portion of the investments were focused on e-commerce and portal businesses. Besides that, SoftBank's China venture capital was also established at the same period. That was the time when SoftBank started to move into China's growing e-commerce market. Therefore, Alibaba was one of the companies that SoftBank was targeting at. Then let's look at Alibaba. So why did SoftBank only invest in Alibaba instead of other internet companies in China? Well, Alibaba was established back in 1999 in China. So by the time SoftBank invested in it, Alibaba was just a very young startup, but with huge ambition. Actually, Alibaba was so promising that it attracted many international investors, including Goldman Sachs, Fidelity Capital, Venture TDF, and others. Actually, before SoftBank, Goldman has already raised $5 million for Alibaba. And that's why Jack Ma kept telling Masayoshi Son that they were not lack of money, and eventually he only accepted $20 million instead of the 30 that Masayoshi Son had previously offered. After quick glances of the two companies, there actually appeared several macro trends that contributed to the success of Alibaba and SoftBank, of course. In the early 20th century, China had a growing market for e-commerce businesses, and the prevalence of internet usage also contributed the potential of the market. Besides, it was the time when China was about to join the World Trade Organization, and everyone believed that the government will implement some favorable policies to stimulate the e-commerce businesses. And it turned out to be true very soon. So besides all that, the investors also played essential roles in Alibaba's growing throughout many years in the history. Now, a fun fact is that people like to dramatize the story, and you may have seen something like how Jack Ma took 6 minutes to persuade SoftBank CEO. Well, that's a little bit exaggerated, but in fact, they do share a lot of common characters in reality. Just as Masayoshi Son once said, they are the same animal and they are both a little bit crazy. Well, I guess maybe that's the thing made them a success. Very interestingly, SoftBank had been holding Alibaba's shares for almost 16 years until they planned to sell part of its stake in 2016 in order to finance its other projects. Well, so we looked up Alibaba's annual report and found that actually SoftBank has been selling its shares during recent years from 32% in 2016 to 29.2% in 2007, and until now, like around 26%. So, considering SoftBank's current situation, it's very interesting to wait and see Whether Masayoshi Son will sell more shares in the future, well, we can get back to this point later.
Now we have known about the successful investment case of SoftBank, but it doesn't succeed in all the investments. SoftBank is famous for making outsized bet on technical startups. However, last year, by using the same pattern to invest in WeWork, it was ended in a fiasco. Let's first learn about WeWork. WeWork is an American commercial real estate company that designs and builds physical and virtual shared spaces and office services for entrepreneurs and companies. How can this company lead to huge loss to SoftBank? Here is a brief introduction to what happened. SoftBank started investing in WeWork from 2017. In early 2019, SoftBank pushed WeWork's value as high as $47 billion. By the fall, Wall Street roundly rejected WeWork's planned initial public offering. Then WeWork announced to postpone its IPO. Now we look into details. First, we look at SoftBank investment timeline. SoftBank invested $3 billion in February 2017, $4.4 billion in August 2017, $3 billion in November 2018, and $2 billion in January 2019. Next, we look at a line chart showing WeWork's historical valuation. It's obvious that there is a turning point at the time of August 2017. Before the turning point, the valuation grows steadily. After that, it increases extremely fast. WeWork's value skyrockets from $21 billion to $48 billion. It's the period that WeWork took investments from SoftBank. SoftBank's investment set WeWork's value $27 billion higher. We can know that SoftBank tended to earn money by showering WeWork with money, demanding frantic growth, driving valuation higher, and profiting from ballooning valuations. However, the problem is that WeWork is overvalued too much. Why we say WeWork is overvalued? I will explain this from two aspects. The first is its spiraling losses, and the second is its risky business model. First, let's look at WeWork's balance sheet. We focus on the revenue and net loss in the past 3 years. Here is a table to compare its revenue with net loss for each year. We can know WeWork generated increasing revenues along with increasing huge loss. It's hard to believe that the business can generate profits in the future. The continuous and increasing losses doesn't match with its high valuation at all. As for business model, the two parts in the left are copied from WeWork's S1. Here I highlight four figures. $4 billion versus $47.2 billion, 15 months versus 15 years. WeWork's business model is signing long-term leases on properties and subleasing for relatively short durations. Under the situation, expanding aggressively means more risky for WeWork. So it's not a wise decision to drive WeWork to expand fast to make its valuation higher. Then, let's look at SoftBank's reflection on the fiasco. In a financial presentation of SoftBank, some acknowledged that WeWork is a massively loss-making business. And according to SoftBank's financials, WeWork is worth around $8 billion now. Some also raised the proposed measures to improve profitability. They are post-contracting new offices, cost reduction, and sort out unprofitable. The interesting part of some slides is the tiny lines in the bottom. For example, there are two pictures of his slides. The verse like no assurance may differ shows that WeWork is a heavy blow to SoftBank's confidence.
In this part, let's compare SoftBank Vision Fund with another famous venture capital, Sequoia, especially Sequoia China. Sequoia Capital is an American venture capital firm. The firm locates in California and mainly focuses on the technology industry. Now, it controls $1.4 trillion of combined stock market value. It also has several local funds in India, Israel, and China. Like SoftBank, Sequoia is also interested in technology, and they both have a huge amount of capital. You may not hear about Sequoia before, but you must have used some service provided by its investees. The most successful one is WhatsApp. And for Sequoia China, let's see. The local fund in China established in 2005. The founders Zhang Fan and Shen Nanpeng, who are known as the most famous venture capitalists in China, helped Sequoia Capital to raise $1 billion and 1 billion yuan as an initial investment fund. Sequoia Capital China specializes in technology, media, healthcare, commercial service, and industry technology, investing over 300 Chinese enterprises. The right-hand side shows several investing companies, like Meituan. It's like Foodpanda, but I think it's more functional, which is very popular in mainland China. To compare with Vision Fund and Sequoia China, firstly, I am interested in their investment strategy. Let's see what industry they focus on. For Vision Fund's top 6 investees, except Uber and WeWork, others are high-tech companies, like ARM Holdings and NVIDIA. They both focus on producing semiconductors. It's not surprising why Vision Funds focus on technology. Song sold a patent for a pocket translator, earning $1 million when he was a student at UC Berkeley. This early success fuels his passions of invention. For Sequoia China, in contrast, they are multi-field investors. The top 3 industries are consumer service, healthcare, and retail. Even though Sequoia introduced themselves as a technology investor, the fact is technology is only a minor part, which mainly included in the healthcare industry. Secondly, let's consider the investing stage. The curve shows revenue through the financing circle. The value of debt occurred in the seed and angel stage. In the case of Alibaba, SoftBank invested $20 million in 2000, which is a very early stage. You know, Alibaba established in 1999, while Sequoia China didn't invest it until 2011. In fact, this example is just a minority. The following chart shows the number of reported venture deals at different stages of the funded circle in Q3 2018. For Sequoia, 46% of deals happened in Series A, while only 5% occurred such early for SoftBank. There are another 15 deals of Sequoia doesn't count, which happened even earlier in seed and angel stage. Also, we are interested in their investment performance. According to a slide from SoftBank's shareholders meeting, the accumulated return is 15 times of accumulated investment. The internal rate of return is surprising 45%. The corresponding data of Sequoia is 21 times and 29%. But attention, SoftBank calculates their IRR using only a specific portfolio, which means they may include heavy weights of successful deals and light weight of unsuccessful ones. In summary, the significant risk for the 2 companies is quite different due to their various investment strategies. For Vision Fund, because it invests in multiple companies in specific business fields, which in some cases leads to a high level of concentration of investments. For example, it has invested in companies that provide ride-sharing service, including Uber, Didi, and Grab. In such business fields, a deterioration in the business environment could result in severe loss in the results of operations. For Sequoia China, it invests in many setups in Series A or even earlier. If you still remember the revenue curve and the value of debt, the risk of financing an angel stage is very high. Significant risk factors are principal risk, return risk, and liquidity risk. Issues like constant monitoring is very useful to lower this risk. Let's back to SoftBank, see how Bryant gives his perspective to the future of Song and his group.
Hi everyone, I'm Brian, and today I'm going to talk about the prospect. Yes, the prospect, because this guy will never stop his investments. So first, I'm going to talk about Vision Fund 2 and Vision Funds. By Vision Funds, I mean there can't just be Vision Fund and Vision Fund 2. There are going to be Vision Fund 3, 4, 5, and also a lot of Vision Funds in the future. And second, I'm going to talk about the strategies that Song will take in the future. Some are the same as before, some are different. Thirdly, I'm going to talk about how the market reacts to different news about SoftBank. And lastly, I'm going to discuss about some risks that they're facing now and in the future. Alright, why don't we get started with his ambitious plan, which is that he's going to build a new fund every 2 to 3 years. This is huge. It seems like to some, building a new fund of several billions of dollars is like a piece of cake. In 2019 last summer, he announced that there's going to be a new fund of a size of $108 billion in 2020. However, it turns out there's no chance for them to have that amount of money after the WeWork failure. So they actually have changed the plan privately to $38 billion. Well, it sounds like a reasonable thing because, theoretically speaking, if a fund size is too large, their return may be affected. So cutting the fund size may kind of enhance their performance. However, don't forget, $38 billion is still a big number. So actually, this is a strategy for Sun to buy him some time, because he needs time to change his investment style, and also he has to wait for the market to cool down from the WeWork failure. Also, he needs to gain the confidence from the investors again. So what exactly the investment style is? Let's see the next page. Strategy 1. Attract more investors. Previously, Vision Fund is mainly supported by 2 large funds from the Middle East, and also SoftBank itself. However, after the WeWork failure, I don't think these 2 funds are still gonna be brave enough to keep investing. However, Som has found new investors like Apple, Microsoft, and Foxconn. They'll have no idea how he convinced them. But anyway, it's a good signal. Strategy 2. Quick profits. Previously, the investment from Vision Fund is mainly focused on tech-related companies like Uber and WeWork, which may need a lot of time to mature. So now Song has announced that they will start to find companies with clearer pathways to profitability and public offerings. He just can't wait for that long. This may somewhat reduce their long-term investment risks. However, his style of pushing managers to higher efficiency doesn't change at all, and it's yet to be seen whether this strategy works. Last strategy, never sell Alibaba. In December last year, Jefferies, a boutique investment bank, projected that SoftBank is going to reallocate their Alibaba shares. Well, Song doesn't think so. In February this year, Song announced that they're not in a hurry to sell Alibaba shares. And he's like, oh, this is my only successful investment and don't persuade me to sell it. Probably he's just not that confident because he needs this kind of fortune for a security reason in case he wastes all his money in the future. Alright, what about the market? Well, if we take a look at the stock price of SoftBank, we can see clearly that after WeWork issue last year, their stock price kept going down until November, when everything started to get better. Some first announced that WeWork will profit in 4 to 6 years, and then Vision Fund 2 will be complete in 2020, and then Vision Fund will also profit again. Finally, they're gonna profit. Some use all kinds of words to comfort their investors, and their stock price did get pushed up. However, the reality is, Wall Street Journal notified us this year about the failure of Vision Fund 2 meeting their goal, and then the coronavirus comes and shakes the whole global market. I'm really curious about how Song can fulfill his promises, and I'm not that optimistic about the near future. Lastly, I'm going to talk about some risks that they're facing. On the optional risk side, their management style and company culture, as we can see from the article the professor gave us, are hierarchical, and I don't think many employees can bear this kind of pressure, especially when a lot of negative news come around. And secondly, the Saudi PIF, which is the biggest shareholder of Vision Fund, says that they won't invest again until Vision Fund succeeds. So I think that Song really has to struggle to regain their trust. If we look at the market risk, we can see that accidents like coronavirus may heavily damage their portfolio, especially when their focus is only on a few certain industries. So it's going to be better if they can diversify their portfolio a bit more. Lastly, the ongoing US-China trade war is still in phase 1, so no one knows what's going to happen in the future. So there may still exist some currency risks and also commodity risks as well. Well, to summarize, someone says that Masayoshi Son is like a pirate captain who controls his own ship to explore the endless sea. Of course, there are going to be a lot of risks, setbacks, and also achievements. But in terms of where he will be and what he's going to end up with, no one knows. But there's one thing for sure, which is that he doesn't care. So what we should do is to just wait and see how he reaches his goal. Thank you so much for listening, and we really appreciate it.